Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. On the podcast, I look to distill the best practices and best ideas of among the world's most successful investors, families, and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners and viewers of the podcast with an eye towards the future of successful investors, families, and their family offices. I am doing something unique today. It is not quite a solo. It is myself along with JJ Sowers, who's a very successful investor, angel investor, and has been active in the world of crypto and digital assets for a long time and is a true thought leader. And we both teamed up and wrote a comprehensive white paper. You could email me and request it, more focused from an investor's perspective and a family office, both a principal and a family office executive, whether a single family office or a multifamily office, that would like to be more familiar with Bitcoin, Ethereum, and really the whole crypto, blockchain, and digital assets community. So what we did is said, hey, let's write this white paper, which we did, and then let's also, why not? Let's also produce a private podcast, which is what we're calling this. I'm not doing it with a live audience, and it's going to be really freewheeling, not overly structured, and rather detailed. So I'm going to say it's beginning to intermediate level, but it's going to get pretty advanced on some things as well. So I think it's going to really check the box on many, many different things. So what we're calling it, everyone, is Chain Reaction: Why the World's Wealthiest Families and Their Family Offices Should Consider Bitcoin and Ethereum and engage in the new digital economy of crypto, blockchain, decentralized finance, tokenization, stable coins, and non-fungible tokens. So we have a lot of things to cover here. Again, this will be a longer form kind of interview, I guess you could say, or back and forth. I'm really excited about it. Grab a cup of coffee, a tea. Again, you're going to settle in. This is going to be a long one. So why don't I begin right now? So I personally have conducted and immersed myself into a journey of Bitcoin, Ethereum, and other cryptos, and really disruptive digital innovation. When did I first become familiar with this? I mean, it had to be back in about 2012. I attended a program by a friend who's a family office in LA, and he had some amazing speakers about this. And I'm like, what is this? And I'm like, back then I was in my mid 40s, although I enjoyed technology, I was far from a technologist. And I heard Brock Pierce and others talk about it, and they were very engaging, but I don't know if I wrapped my arms around it. So maybe a year later, I'm back in Greenwich, Connecticut, where my business is based. And many of you know of the Winklevi twins. And I heard Tyler and Cameron at an event hosted by a firm called Withers Bergman, a prominent legal firm, talk about it. And I'm like, okay, I'm hearing this a couple of times now. It's interesting. I think I have an obligation to learn a little more about, Satoshi and read the paper. And I still wasn't quite ready yet. In 2017, I made my first incredibly modest purchase. And then, of course, a couple of months later, it goes down. Luckily, I didn't sell. I didn't really give it that much attention. And I've had some amazing speakers at Family Office Association on this, including Barry Silbert in 2016, Brian Kelly, Mark Yusko, Pomp, and others. And for me, really, during COVID, as I've had more time to be a deeper thinker, thought leader, and immerse myself in many different things, maybe on behalf of my family offices, a couple of months ago, I really dove in. I put in a lot of research and a lot of time, and I started to engage myself in the process of buying, investing, etc., so I could really go through it. And that led me to be introduced to, James JJ Sowers, and really impressed. And he's helped me go to multiple other levels in my knowledge. And I had a chance, many of you will be familiar with Raoul Pal, Lynn Alden, and her work is great in writing on the misconceptions of Bitcoin and the work that Michael Saylor, who's very thoughtful, has done, and Robert Breedlove and Dan Tapiero and others, Brian Kelly, who I before noted, and really to dive into it. And so what I'm going to talk about now is, mainly I'm sharing my analysis, my opinion, and I guess you could say my conclusions. But as I'm recording this on the 24th of December, things are changing so rapidly in this community. I don't know how dated this is going to be, like even a week later. So why don't I begin? Well, first, very bad manners of me, James. Welcome. How are you?
How are you? Thanks for having me.
Awesome. It's great to have you here. And, you're really a true thought leader. So it's exciting to have co-written the paper with you and doing this private podcast together. And hopefully it's something that, our audiences are going to enjoy. So now that I've laid a little bit of the groundwork, why don't I start with a comment? Many of the world's wealthiest families and their family offices are at zero in their purchasing experience and allocation to Bitcoin, let alone other cryptocurrencies. And I think that this is a mistake. I think they need, you talk about this so eloquently, before you decide to invest, and you should not invest with the crowd or willy-nilly. You should take the darn time, do some research, even if it's 10 or 20 hours, do some research and form a thesis. Since you're a true investor and you've studied the greatest investors, in the world, and you've done that since you were a kid, and you were entrepreneurial since you were a kid, talk a little bit about your process for doing research and forming a thesis.
Yeah, so I learned as a kid, just reading all these books at the library, that all the true innovators, not only in business and investing, but in sports or anything in life that I read about, they were kind of independent thinkers. So they took in all the information around them and they formed their own thoughts and thesis, kind of like critical thinking. And I always say, I don't want people to think what I think. I just want them to think for themselves. And I've noticed in life, a lot of people tend to not generally think for themselves in some areas. Like even very successful people, they'll think for themselves in certain areas, have their own thesis, but in stuff they're not real familiar with, they'll kind of just take the conventional wisdom or what they hear the most on TV. But I've learned that generally in life, when 99% of people say something, it's probably wrong. So you really need to take the time and have your own thoughts, do your own research, even minimal, just so you can have a basic thesis of life and where things are going in the world. Because I believe technology is moving so fast, people are going to be left behind. It's just like longevity and things like that, I think, are going to really accelerate in the next decade, that people that are 70 now and think, I only have about 10, 15 good years, maybe 20, maybe if I'm lucky, 30. They're going to live another 30 years and they're going to be 100 and they're going to feel like when they were 50 years old because of anti-aging and things like that. They're like, oh my God, all this time is going by. I really need to catch up. And they're really going to be left behind. It's just like a lot of people talk about the iPhone and stuff in the last 12, 13 years. Just imagine what that was, the smartphone when it first started and what it is now. So imagine if they have the exponential growth in longevity and things like that. And I really think we're moving into an age where money is going to be disrupted via programmable money. So just imagine that, because everybody uses money. It's not like some things where people don't use them and they're like, okay, I don't have to pertain to that. Everyone has to pertain to money.
For sure. And I think that's a really good overview from your perspective. So, I kind of hinted many of the family offices are at zero. For sure, at most, the penetration of investing in this community is well into the early single digits among families. And usually successful families are the early adopters into much that may be considered alternative investments. Go back to hedge funds and venture capital in the 50s, the birth of private equity industry and real estate industries, and institutional investors followed. But this has been one case where the families have been a little bit slow, that it's been the technologist, it's been more the generically high net worth or the everyday people. And that's great, kudos. And that probably says something about the democratization. I messed that up, but you know what I mean by that, about the power of Bitcoin and blockchain. You don't have to be super rich. You could buy a tiny, tiny percentage. So, kudos, hats off. Those were actually the early adopters here. I think part of this, and I know I get in trouble when I say this, I'm just being honest. Part of this is an age thing. Look at the numbers. The numbers state, I think it's like 3% of baby boomers have had some experience exploring Bitcoin, and it might have been buying it, where it's like 39% of millennials. And imagine the Generation Z, that number is going to go up. So I would ask you, listen, have a beginner's mindset, realize things are changing rapidly. Look at the internet that had like 1% penetration in 1995, and now billions of people have access. Look at, like James said about the iPhone. It's hard to believe it's only like 12 years old. It's amazing. How can we get by without it? And that's accelerating exponentially at an even faster rate. Now we'll get to, probably the most common questions I get are, how do I buy it? And then how do I store it safely? And I promise we're going to get to those. And we're actually going to do a really deep dive into that storing aspect, because that's a big subject. But I want to touch on something that James said related to the age thing. Don't put in the time, do a thesis, at least 10 or 20 hours. And if you decide, there's certain risk here, and there are risks, absolutely, then at least you made a thesis that I'm not doing it. And I respect that. I've interviewed billionaires on stage that are older, and involved in from banking to real estate. And when I asked them about it, and I didn't have the knowledge or confidence back then a couple of years ago, they kind of poo-pooed it. Not because they put in research, it's because they didn't understand it and they didn't want to take the time. It didn't feel right to them. Now, again, I think the best risk mitigation strategy is to really, really limit your exposure. For some, under 1%, for others, maybe 1 to 3%. And then as you get more comfortable and get more experienced investing, perhaps for some of you, you could do more. But what James said about aging is completely true. I'm not going to make this a biotech and anti-aging podcast. Although I'm very active in those communities as an investor and as someone who's deeply connected from what I do at Family Office Association, there's some tremendous breakthroughs that we're going through right now, and many more that are coming like really, really soon. Yeah, you may be 70 and you may live to be 100, 110, 120. So do you want to be left behind? Do you want to have your assets too much in cash, treasuries, and bonds, that if inflation goes up, your purchasing power is going to go to garbage? If you're spending more than probably about 4 to 4.5% of your assets every year, and I know billionaires that are closer to 7 or 8%, don't think that your purchasing power over decades could just be decimated. So sometimes wealth preservation over decades really equates to wealth growth. You need to mitigate risk for sure. Now, again, that's a subject we could do a separate podcast about, and I probably will. So the other thing I was going to mention is I've interviewed so many global macro traders at Family Office Association, my events over the years, and so many of them now are on record as investors in Bitcoin. And almost all, even if it's just personally, have Bitcoin and gold. And I don't think they're mutually exclusive. I think gold is great as well. But like Tudor Jones said, I simply think Bitcoin has some advantages and is going to be the fastest race in the horse. And from what great investors that I know are doing, they're allocating more and more, and maybe carefully, into Bitcoin. So I'm going to start a little bit by talking about a conclusion from my opinion. Among cryptocurrencies, Bitcoin specifically, yes, it is money. It is an asset class. It is a technology, money over IP, and a store of value, although admittingly volatile. So Bitcoin is the original decentralized cryptocurrency. It's independent of government manipulation. Now, it gets a little bit complicated. We're going to cover some of that later. But in theory, independent of central bank interference or any singular administrator, It's easily and digitally sent from Bitcoin user to Bitcoin user for goods and services, family and friends, without the need for an intermediary. Where I'm going to like for James to jump in, and we don't want to make this too techie, but I think there needs to be a little bit of a grounding and understanding. So many of you are going to be, like now I'm familiar with Bitcoin and it runs on the Bitcoin blockchain, but I get a little lost about what are these nodes and miners and hash power. Now, James, let's not make it a technical discussion, but maybe in 2 or 3 minutes, if we could lay a little bit of a foundation relative to that.
Yeah, I would say the easiest way to think of a node is any system or device connected to a network. So instead of worrying about all the minutiae about the Bitcoin blockchain and how those nodes actually work, which we do give a brief definition in the paper, just as an overview, I think simplest is always best. I learned reading about, I think it's called Occam's razor as a child. The simplest answer is the best. So I also learned too, the simplest way to understand is taking the simplest path. Just like, for instance, if you can explain something in one sentence to your grandmother and a 7-year-old, and they would both basically understand, that's kind of the best way to get an understanding of something, especially when you're first learning or exploring or researching. So I just go back to any system or device connected to a network as a node. So just think of it that way. And the miners are part of the Bitcoin network, and they do this thing called cryptocurrency mining. And there's this thing that we do touch on called proof of work, where they're basically solving a mathematical problem to earn the reward. So I look at it this way. The miners are just maintaining the network, keeping it secure, making sure it runs smoothly. And as this happens, they get their rewards, because otherwise, why would they do it? So they have to be incentivized. And just a little brief thing on mining too. It's not like mining, like, people think digging for gold is mining and all this other kind of stuff. And they do have equipment when they mine for gold, obviously. So in cryptocurrency, there is equipment, but it's computer equipment. And it's basically a bunch of GPU cards that are put together. And then you have, of course, a motherboard. And then it's interesting too, because you also have to have a fan, kind of like a cooling system, because these rigs get very, very, very hot. And generally, these mining rigs do not have a monitor. So when you think of computers, people think of a computer monitor, but you don't need that for mining. So that's kind of interesting. And you do need a certain amount of computer hard drive space when you do this. About 250 gigabytes of memory is what most people say. Some people say you can do it with 100, but obviously the more gigabytes you have, the better, because remember, the fastest computer and the one that's most efficient is the one that's going to win the reward. And you also have to have a cryptocurrency wallet, things like that. They take up about, I would say, 25 gigabytes of space, maybe 50. And you need several GPU cards working together in tandem, because just having one, you wouldn't have enough power. And as time goes on, you need more and more and more, and these mining rigs or pools become concentrated because people pool together and form a group in order to win the reward.
For sure. And, getting hopefully not too far off track. And I know it's become much harder without those pools to, get the rewards of being a miner. But, a name that people in my community are going to know, like Abby Johnson from the Fidelity family fame and running Fidelity and very sharply, got involved in Bitcoin relatively pretty early, and supposedly from like her office had like a mining operation. And now Fidelity, being well ahead of the curve, has Fidelity Digital. That definitely is a quality organization doing wonderful work on custody as well. And we'll cover much of those topics to come. But like someone of that prominence actually, getting into the weeds and becoming quote unquote a miner was actually, I was impressed by that. Why don't we talk a little bit about the blockchain and about what a revolutionary, I'm going to use that word, invention it is. So you may give the analogy of like using railroads, it's the rails. And in this case, Bitcoin is the train, but I would love to hear your definition of it.
Yeah, so I just kind of think very simply that blockchain is basically just a decentralized distributed database, which people call, the digital ledger. And it records all the transactions across many computers so people can't just alter the blocks. So that's the beauty of the blockchain. You can't just easily erase the ledger or the record or whatever you want to call it, because the entire blockchain basically gets downloaded every time it's confirmed, and you'd have to erase every previous block that ever happened if you just wanted to erase the last block. So that makes it very, 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 very difficult, if not almost impossible, for someone to alter. Now, obviously, nothing is impossible, but it's very, very hard to do. Would take a lot of cost. You would have to do this thing called a 51% attack. I mean, it's almost impossible at this point because the blockchain is so far along. The further along it gets, the harder it is to kind of reverse this thing.
For sure. And those are, great commentaries. A common question that I get, and I think it's a fair question, and I kind of agree with it, kind of. And that basically is, Angelo, I don't invest in what I don't know. But I think this is so revolutionary. My response to that is a pretty simple one. That's unacceptable that you don't know. So begin to know. Put in some level of research into it, because I think this is going to be so valuable. Again, I think it's revolutionary, much more than blockchain and crypto and Bitcoin, but the whole ecosystem and things we're going to talk about, in decentralized finance, et cetera, and some of that upcoming. So that's an unacceptable excuse. Start to know. Now, do you need to become an expert? No. Do you know how your combustional engine works in your car? I mean, unless you're a mechanic, probably not. Could you take it apart and build it? Do you exactly know how a jet flies? So you don't have to become a technologist or an expert, an engineer, or rocket scientist. Come on. But you do got to put in, I agree, a level of time to form your own thesis. So, this goes back a little bit in keeping the flow of what we wanted to talk about to what is money? I mean, I guess you could say it's an economic unit that functions as a generally recognized medium of exchange for transactional purposes, goods and services in an economy. Money must have certain properties, I guess, right, to be universally recognized. I'd probably define that as durable, portable, divisible, and recognizable, scarce. So to me, although imperfect, specifically Bitcoin, and we're not going to do a super deep dive into that for the purposes of money for small transactions, although the community's gotten pretty creative around that. But yes, it does check the box on that. How about a store of value? So what is a store of value? It's an asset that maintains its value rather than depreciating. For sure, gold and other precious metals are good stores of value. Partially due to their shelf life is essentially perpetual, and it has withstood, I'll admit that, it has withstood the test of time. A nation's currency must be a reasonable store of value for its economy to function. So something that I talk about that I find intriguing about the world of Bitcoin is kind of quote unquote, is it the new Swiss bank? So my members and a lot of my larger families know I wax poetically about becoming a global citizen, or at least having optionality, and having diverse business interest and proper entities structured around the world, including offshore insurance companies, which we're not going to do a deep dive into. It has nothing really to do with this, and potentially banks, including in Switzerland. But that's really complex and has certain drawbacks. What I find intriguing specifically about Bitcoin and other cryptos is it does replace some of the value of risk mitigation and wealth preservation, partially to self-sovereignty, store value, custody, and risk control that you would get by the complexities of being a billionaire and owning a bank. So like anyone could have some of those aspects, no matter who they are. So that's an analogy that I like to give that may help certain families understand, its true potential. I would say the next thing that we talk about, James, is Bitcoin an investment, an asset class? And I think the answer to that is a resounding yes, especially everything that we're starting to see. So besides money in a store of value, Bitcoin for sure is an investment. It could go up and down. Now, would I say it's a cash equivalent? Well, Michael Saylor, we'll get to him a little later. He's the public company CEO and founder, I believe, of MicroStrategy, and they have a tremendous amount of Bitcoin on their corporate treasury. And he's very eloquent in talking about the impact of inflation, the fact that government hides, quote unquote, true inflation, and really the purchasing power and a big, big, big advocate of Bitcoin. I suggest you look him up. If you're not familiar with him, follow him on Twitter and read some of his work and his interviews because he is very, very thoughtful. But just look at the level of investors that many of us are going to know the brand names, and actually much of it just this year. So you have what? Paul Tudor Jones, Stan Druckenmiller. I mean, legendary macro thinkers and investors. You have the great Cathie Wood, and she spoke about it at Investing in Tech, a seminar put on by Barron's. And she's the founder and CEO of ARK. If you're not familiar with them, again, look her up. She's an amazing thought leader. And just look at, as of a couple of days ago, Bitcoin was about 23,000 a full coin. So for sure, it's becoming recognized by big true investors and institutions. We'll probably get to Mass Mutual. Now, admittingly, putting well under 1%, but still 100 million into Bitcoin. Look at JP Morgan having over 100 people in their digital assets division, Goldman Sachs being active and getting active in this community, the quality of the level of custodians. There's for sure going to be much more of a groundswell among family offices and institutions into Bitcoin specifically. James, why don't I get some of your opinion on Bitcoin as an investment, / an asset class?
Yeah, so I think it's pretty interesting that Bitcoin can be three different things, even to one person. It can be insurance in case we have like a hyperinflation or a defense against the dollar collapsing or something like that. It's obviously definitely an asset class now. I don't even think anyone can argue that intelligently. Once they had a futures contract on the CME, it became an asset class.
Great point.
And then it's most importantly a technology, money over IP. Because I've always wondered, growing up, how we send the email and you press a button and the email goes over. Why can't we just do a transaction that settles with a bank or a cross-border payment instantly where you press a button? And the blockchain technology and Bitcoin money over IP actually allows that. Basically instant settlement, within seconds or minutes, depending on how congested a network is. Why couldn't we have that? So we're really evolving towards money over IP, just pressing a button and the money goes over the internet rails, which would be the blockchain now, and settles very quickly, removes friction, lowers costs, things of that nature. And the great thing about Bitcoin too is the asymmetric bet. I mean, this thing could, even now at 20-some thousand, could go 10x, 20x, even crazy as it sounds, 100x. I mean, suppose cryptocurrencies and Bitcoin are like the Dow in the stock market when they first started. It was a very low level, had to start somewhere. Dow was 100, 200. And then 1,000, people said, oh my God, this is so high. And then it's 10,000, and now it's 30,000. Why couldn't Bitcoin be 20,000 a day and over a number of decades, one day even be 1 million just based on that? I mean, nobody really knows where this thing could go. Obviously, anything can happen, and everyone always says, oh, well, Bitcoin's going to get diluted by the other cryptocurrencies or disrupted. Really? Because it's the furthest one along. It's got such a robust network. It'd be like saying that the Dow is going to be, diluted because there's other indexes or so many other stock competitors.
Yeah, that's, some excellent points. Now, I will remind people that it is volatile. You absolutely could lose money. So it's not something that is going to be assured of going up. I think the charts and the trending from putting the research in are going to be optimistic over time. But in the short term, it could be very volatile, and that will likely dampen as more higher level investors come in and for a variety of other quote unquote factors. But in theory, no guarantees here. Absolutely, you can lose money, which is why initially limit your exposure and your asset allocation to a relatively very modest percentage. What I will talk a little bit about, it could be a little bit of a boring subject, so I'll kind of breeze through it, but it is in the paper. And it's really understanding, going back to what I said about what is money, the history of money. Well, money as defined is generally recognized medium of exchange for goods and services, like I mentioned. In the earliest times, and I mean earliest times, this was bartering, exchanging goods and services within a community. One party had what? Beans, the other apples. They can barter. This evolved into exchanging something perceived, and I did emphasize that, perceived as valuable for goods and services. Shells, yes, that was one. Gems, gold, metals. The value of such early stage monetary resources is only based on what another person believes based on desire and scarcity. The person exchanging goods and services for a specific amount of gold perceives the gold as a fair exchange that they can utilize to either hold or early speculation, hold or purchase other goods and services. It takes a minimum of two parties to agree to the value and use it as what I'm going to call quote unquote money. Governments began issuing currency, what we now call, I guess, fiat currency, traces back to Mesopotamian shekel. This was the first form of a coin currency, as far as I remember. Well, I am pretty old, but that does go back 5,000 years, but from research. And it was the Chinese that developed the first system of paper money, and that goes back to about 770 BC. Governments since then have tried and successfully corralled the market of their currency in exchange for goods and services. Understand that paper money in and of itself, really has no actual value. It's not backed by gold anymore. It used to be. It really is just a piece of paper. It's symbolic because it conveys the importance that people place on it. A $100 bill is only worth $100 because it's backed by the full faith and credit of the United States. But that, things change. Look at what's going on with modern monetary policy, with our deficit. And again, there are radical changes historically, often in like 75-year increments when you go back and you do a little bit of research on money. And for sure, with hyperinflation and a variety of factors, it could all kind of blow up in smoke. I'm going to talk a little bit because I think it's important, especially for earlier stage investors that are a little bit more older and conservative, to kind of understand some of the sequence of what I'm talking about. So that relates as well to kind of the origins of banks. And this goes back approximately to 1397, the official founding date of the Medici Bank of the Medici family in Italy. And they had some incredible contributions in a major way to what would become the banking system, inventing the general ledger of debits and credits, the birth of the double entry accounting system. And noticed what James said earlier about blockchain and how that basically took it from kind of analog to digital. So, someone back then, I guess, would go into the Medici Bank and exchange their Italian currency for a note from the bank. And the note was secured by the bank, providing the perception of safety from, say, theft and fire. I guess the bank paid at that time a very modest interest rate. And they were looking at the same way that they're profitable now from taking in resources and lending, this is the earliest stages of really the whole general ledger system of debits and credits, double entry accounting. Now, governments, of course, over time became much more involved, and rightfully so, and intertwined with the banking system as it's now highly complex and regulated. Much greater oversight by banking authorities. But really look at it, other than that and technology enhancements, not much has really changed until Satoshi Nakamoto, whether one individual or a group, in late 2008, writing the original 9-page paper, and you have to read that. Just look it up online as part of your diligence. And then, I guess, launching Bitcoin officially and on the Bitcoin blockchain in early 2009. There really has not been massive developments in all of what I just said, per se, about money and banking and the traditional ledger system until this. This is so revolutionary. Maybe from your perspective, James, if you wanted to comment a little bit about that, and I didn't even get into yet, a tremendous advantage is our governments can print money like there's no tomorrow. We're seeing it happen now. And potentially in the very near future, the devastating effects of that. A powerful, powerful advantage of Bitcoin is that it's limited, capped at 21 million, and maybe now there's close to 18.5 or 19 million. But why don't I let you jump in and comment if you wanted about anything that I said, or jump into some simply those advantages relative to government money, relative to Bitcoin and other cryptos.
Right. The great thing about Bitcoin is it's about, I think, 18.6, almost 18.7 now, because they mine a block every approximately 10 minutes, more Bitcoin's created. But the great thing about it is every 4 years, and we just had one, they have this thing called the halving. So the amount of supply that comes out to the market, for lack of a better term, is halved. So they're controlling the amount of inflation, which is the inverse of what governments do. They just print on a whim, for lack of a better term. So there's no control over the inflation of the money that's being created by governments. But Bitcoin has a computerized, by the code, control of how much money can be created, for lack of a better term. So you know that there's going to be a fixed supply of Bitcoin coming to the market every so often. And every 4 years, the amount that can be created is cut in half. So it's almost like a control of the inflation of the amount being created, which is totally opposite to traditional money systems these days, where they just keep printing more and more money at their whims. And they're like, oh, let's just pass it, have some more money come out. So this makes Bitcoin more scarce, more rare, and adds another kind of value to it that you can't really add to paper money. Because people say, fiat money, the only thing it's backed by really is the full faith and credit of the government. And that's very important because, it's backed by the military, the land, the resources, things like that. But Bitcoin is backed by the underlying technology, the blockchain, the ledger, the cryptography, things like that.
Yeah, that's really well said. And I know we're going to get some people, and I understand it, that are going to think, money as of now, I could see, feel, and touch. Gold, I could see, feel, and touch. I believe there's an intrinsic, quote unquote, intrinsic value to gold other than money. And there is, that's a single digit utilization of gold, but that is true. Maybe now's a good time for me. I wanted to quote one of my favorite writers on the subject and kind of helping to wrap your arms around the power of that and understand it. It comes from Jeffrey Tucker, who even earlier this month in December of 2020. So he's of the American Institute for Economic Research and did a great article titled, "Why Does Bitcoin Have Value?" And I'm going to read a very small part of it, but I think it will help some of you wrap your arms around that aspect of it. Here it goes. Bitcoin is both a payment system and money. The payment system is the source of value, while the accounting unit merely expresses that value in terms of price. The unity of money and payment is its most unusual feature, and the one that most commentators have trouble wrapping their heads around. I'll continue a little bit. Bitcoin is not a standalone currency, but a unit of accounting attached to an innovative payment network. Two, this network, and therefore Bitcoin, only obtained its market value through real-time testing in a market environment. And I'm just reading individually now, separately, it's me. Is Bitcoin a better store of value than like Apple stock or gold? Well, I mentioned earlier Michael Saylor, the founder and CEO of a public company, MicroStrategy. So in an interview with Keith McAuliffe who's the CEO of Hedgehog, a great organization as well, he was, besides Apple stock and gold is still investors' favorite store of value. And what Michael Saylor said, and I'm not saying I agree with him perfectly, but I think it's an interesting comment. Here he goes. The truth is, Apple stock is not so scarce. The executive team can and will eventually print more. And if that doesn't dilute you, then you've got regulatory risks, competition risk, execution risk. You got a lot of moving parts. That's why they're not good, according to him, over the long term. He detailed, as for gold, if you put 100 million into gold and the gold miners print 2 to 3% more a year, let's say 2% more. Well, over 100 years, that's a lot. You lose, according to him, 88% of your purchasing power. Saylor believes, as presented in his research and diligence as an intellectual and a technologist that probably played into it, that Bitcoin was simply the best solution. So besides some of the titans that I mentioned earlier and some of the institutions getting involved, many of you are also familiar with Neil Ferguson, the famous historian, did an important op-ed piece in Bloomberg, November of 2020. So recently titled, and look it up, Bitcoin is winning the COVID-19 monetary revolution. Subtitle, the virtual currency is scarce, sovereign, and a great place for the rich, according to him. And he's a pretty prominent guy to store their wealth. So, you're now getting true deep thinkers and thought leaders, people that are not all young and techies, people like Tudor Jones, who's even older than me, that are, realizing some of the great potential here. We spoke a little bit about it, and I gave that quote from Jeffrey Tucker. But to you, James, how would you define, does Bitcoin have value?
So, yeah, it's interesting because everyone has their own opinion, and then you get into this intrinsic value type thing. But I always say, that's kind of like a beauty contest in the eye of the beholder, because someone might say, hey, this fruit has intrinsic value, but someone else might have, say, a different fruit does because you might be allergic to that particular fruit. So obviously that has no value to you. But the way I see it is Bitcoin's value truly is in the technology, and at the very minimum as an insurance policy. But I always say in any technology or investment, the yes if the one thing goes right, how big could this really be? So I think Bitcoin's evolving, and we may not be there 100% yet, to a dominant digital payment network, the true rails of money over IP. Kind of like we were talking about before, that the blockchain is the railroads. And Bitcoin is one of the trains, not the only train, but one of the trains. And if this truly becomes the dominant digital network for money, how much is that worth? I mean, in the trillions. The only reference we have right now are companies like Apple, and it's a couple $1 trillion, give or take. The Microsoft's over $1 trillion. The Alphabet's over $1 trillion. But really, technology is exponential, and I think it's really hard for humans to grasp in our mind the exponentiality of things. So if this truly goes exponential, could this be 10 trillion? Could this be 20 trillion? And at the same time, the way that Apple and the Googles of the world are going to go exponential into the 10 and 20 trillion market caps. And even things like Tesla, being an energy company, not an automobile company, but a clean energy, a storage, a climate change company in the future, could realistically easily be a 5, 10 trillion, and even $100 trillion company. And people think that's insane. So that's kind of how I look at the value of Bitcoin. The true value is in the technology. It's great for insurance at the very lowest of the thesis ring. And then second, digital gold, money over IP. But if it truly becomes the dominant technology for money over IP, the rails, then it's almost unthinkable how valuable it can become.
Yeah, no, that's a great way to think about it. So another thought leader in the community and kind of a massive following on Twitter is, and he chooses to remain anonymous. He's known as Plan B. You could follow him at 100 trillion USD on Twitter. And he's a deep macro thinker in Europe. He's been involved in the community as a macro thinker investor for a long time. And he has something, he's known for his charting, stock to flow, cross asset model. And according to him, and again, it's according to him, if Bitcoin doesn't break its historical path, and by the way, it very well might, but if it doesn't break its historical path, Bitcoin market cap, according to him, will approach gold's market cap of 5 to 10 trillion somewhere in 2021 to 2024, and approach real estate's market, which I guess is probably like 100 trillion, somewhere between 2024 and 2028. Now, again, it may very well break that historical path. But if you're someone who believes in, analytics, metrics, charting, then that's, one, he would be a great follow, but that's something to be aware of the potential of. Now, sometimes I am asked about, Bitcoin and crypto and taxes. For tax purposes in the US, at least, and most other countries, Bitcoin is usually treated as property rather than currency. It is not considered a legal tender by the US government. If you disposed or used your Bitcoin by cashing it in on an exchange or buying goods and services, you will owe taxes of the realized value. And yes, using that as money does make it more complex, although there's going to be greater accounting and other platforms and programs built into merchants and providers that we use that will be able to help calculate that and do that for us. But yes, from that perspective, I guess you could say from liquidating and buying a cup of coffee, at least from the Bitcoin perspective, it's a little bit more complicated. I spoke earlier about among the reasons why the world's wealthiest families have not allocated. And some of it, I think, is simply not putting in the time and research, a little bit of fear. And so what I think is going to happen in the family office community, because I'm a big believer in potential of the digital assets community, is you're going to see families and their CIOs begin to hire internally into the family office people that are dynamic thinkers in this community as families begin, and it's early stage, but begin to allocate some of their percentage of their portfolio, maybe under 1%, maybe 1%, maybe 3%, for some, maybe more. Don't think that, created in 08 or 09, the big gains already happened, I'm too late. Well, I mean, yeah, compared to, pennies back in 09 and looking for, incredible exponential returns. But this is a deeper, longer term game than that. James may say we're kind of entering into the top of the first. I may think a little more of the bottom of the first inning, using a baseball phrase, but that still is so early. But if you wait 3 to 5 more years, so much may happen between now and then. We may already then be in the 4th or 5th inning. That's is all debatable. So among the big challenges from putting more institutional level money, and that means different things to different people, is simply buying in custody. And so much has adapted. I mean, even in the last year, let alone the last couple of years, to make all of that, easier and more convenient. So why don't we dive into, once you decide to put your foot in the water, your toe in the water, and purchase tiny amounts, like, here's how. First of all, from my perspective, not a techie, the easiest is actually Square, the public company, Jack Dorsey, their Cash App. So on your phone, download for free the Cash App. It is incredibly easy to use. You could probably, put your information into it in like 3 or 4 minutes, and it gives you the option of buying Bitcoin. Now, it has some limitations on liquidations in terms of the amount, but you could actually buy like 100,000 a week if you wanted, more than most people think. Of course, I went through the process of doing it, and it was incredibly easy. Now, we'll get into a little later the KYC, know your customer, and how there's certain things, copy of the front and back of your driver's license and asking you a series of questions. So what may happen is buying it was incredibly easy, but then to move it around, it needs to go through the know your customer process, what I mentioned with the driver's license and asking questions, and may take a couple of days for you to get approved. So, again, this is all part of having it more regulated on exchanges and how to buy. And although parts of it are a little frustrating and time consuming, this is still a bit of the wild, wild west. And you're going to want a level of regulatory oversight to make sure they're following certain protocols, that they're living up to what they say they're doing, and are getting some level of oversight from a variety of different perspectives. But among the more common ways is also for people to buy it from a reputable US-based exchange, at least for US citizens, a Coinbase Pro, a Gemini, a Kraken being a couple of examples. And again, they do have to follow, especially now more than ever. We'll get to the proposed Treasury regulations in a little while. But again, the KYC, the know your customer. And again, I think, and some may disagree, this is kind of good. It somewhat institutionalizes the process. And again, this used to be a bit of the wild, wild west where things could go terribly wrong. And now that's much, much, much less likely to happen. So one way, besides the ease of the way that I noted, is to open an account on one of the exchanges. And you could do that again, from your phone easily. Choose a highly secure password, including lower and uppercase letters, numbers, and symbols. Once you get approved, and depending on the platform, that may happen upon purchase or upon moving around or liquidation of your Bitcoin. And I'd recommend small, I don't know, $100, $1,000, maybe $2,500. Just immerse yourself and get familiar with the process. And by the way, whether it's from Square's Cash App or even PayPal and upcoming Apple Pay, Apple is now involved. But from the exchanges that I'm noting, it's easy to loop in your debit card. So that's going to tie into your bank account to help fund the money that you're not doing on credit. It's from your bank account. So there's various ways, and credit card could potentially be another. I don't know if I necessarily recommend that, but theoretically, again, go on to what I described. And even PayPal, which I thought was a little more complicated than the Cash App, but actually has more flexibility with other than Bitcoin if you wanted to experiment with some of the other coins. Now, some would argue, not to get a little too deep in the weeds, that, yeah, but because I'm not getting the keys, if I leave it on the exchange, it's kind of like how I purchase a stock and it's registered in the street name of the exchange, but it's ledgered. I mean, I'm the owner, but it's ledgered to me. I don't physically have the keys. And yeah, that is true. But for the amounts of money that we're talking about to get your feet wet, even if it's more than the 2,500, that's probably not something for the purposes of the amounts that we're talking about that I would really be too concerned with. We're going to get very shortly to wallets. And I think James will surprise many of you and say, hey, on the regulated US exchanges, that may be safer for some of your Bitcoin quote unquote holdings. So then once you have that, get experience. What's your thesis in doing it? What was the process like for you? Do you monitor it? Do you watch it? Have you experienced buying and selling yet? These are all going to make it easier for you to make a more strategic, longer term decision and allocation of how you, quote unquote, want to be involved. James, if you now, and I promise I'm going to get to over the counter, which is how larger purchases should be made, and custody. But why don't I let James either comment about the process that I described, and James, roll up your sleeves, everyone. Now we have to dive into as well where people do get lost a little bit. And I hinted at it with, do you leave it on the exchange or do you move it to a wallet, a hot wallet, a paper wallet, a hard wallet, your own cold storage? James, I'm going to sit back, take a sip of my tea and let you do your thing. Go for it.
Great. Yeah, I always say take a weighted barbell approach. So kind of what I mean by that is you have a little bit of everything. So first you form your thesis. And I always say too, if you want to start with say PayPal or Square or when Apple has it, or even Facebook Novi when that comes about, because I believe eventually Facebook Novi's wallet will let you have probably Bitcoin, Ethereum, and things of that nature. I'm just guessing that you wouldn't walk around, just using the Square example, with $100,000 in your physical wallet. So you shouldn't just, automatically say, hey, let's just get $100,000 Bitcoin and keep it in our Square wallet. I mean, maybe you purchase it there and you move it somewhere else. But I say, each person, whether they're a family office or just even a regular guy on the street, should have some amount of Bitcoin just for insurance in their Square Cash App wallet or their PayPal wallet or in the future their Apple wallet, things like that. And then when you start getting into higher levels of purchases, up to 100,000, you might want to have some on an exchange, some in what they call a hot wallet, which is really a software wallet that you can download. And then they have things like hardware wallets, paper wallets. But remember, nothing is 100% secure, and they all have pluses and minuses. And a lot of people think of hardware wallets, well, that's kind of like, the regular man's version of a hardware security module. And in some instances, that's very true, but it's also very, very different. Because basically the hardware security module is it's like a tamper-proof resistant vault. So basically your cryptographic identity is inside that, and without the private key ever leaving the device. So no one can basically steal it. But what a lot of people don't realize, these hardware wallets are great, But most of them, you have to actually get firmware updates, which goes to the internet. You have to do things like that. And whenever you go to add to it or sell your cryptocurrency from an exchange or somewhere, you're connecting to the internet basically at some point in time. So that's kind of some risk there, but it's definitely better than most would say, a hot wallet, which would be a software wallet. But just know your risk. And a lot of people don't realize when you purchase these too, don't buy a used one on like eBay or something, because you don't know if someone installed malware, things like that. And then when you buy it from your manufacturer, just make sure you're really careful and reading the instructions, and they all have different precautions they tell you, just to make sure you're doing it correctly and you're not exposing yourself. Because just doing one little thing wrong that you think is just so innocent can kind of expose yourself with the hot wallets. I mean, they all have their use. And then the paper wallet too, it seems like, oh, wow, the paper wallet, that's really safe. And back years ago, 6-7 years ago, that really was a great way to do it. But nowadays, it's much harder to create a paper wallet. You have to go to different websites on the internet. So how do we know that those websites, somebody's not compromising you and getting your information? So everything kind of has pluses or minuses. And I'm actually kind of a fan of these Bitcoin ATMs, which now some people are calling them cryptocurrency ATMs, because some of them you can actually purchase things other than Bitcoin, but you do have to KYC yourself and do other things. So nothing's truly private anymore, but it's still an interesting way to get a paper wallet. And yes, I know I guess it's possible that when someone prints out this paper wallet on there, somehow your keys, your information could be stored in this Bitcoin ATM. I mean, anything's possible, but I really, really look at, a weighted barbell. So you might want to purchase cryptocurrency in different ways. And another thing too, the reason some of the exchanges are really valuable is because a lot of these things like Square and PayPal, you can't get a lot of the altcoins. So if you want to diversify and make kind of like think of them as venture bets, you do need to go to these exchanges to purchase a lot of these cryptocurrencies. Now, granted, accredited investors and family offices may be able to get in some of the private placements and acquire some of these so-called altcoins before they hit the market. And that may be the best way to get an asymmetric bet, because you can get them at a very low price. And then once they hit the exchange, and a lot of them have lockup periods, as soon as it hits the exchange, your return could be 30x, 100x from what you paid for it, but you may not be able to sell it right away. Almost like a venture bet again, because just like when you invest in a private company and it lists on a public stock exchange, you can't necessarily liquidate your position right away and say, thanks for the big profits. So I kind of look at it that way. Just kind of critical thinking, say, hey, what's my personal plan? Not even an investment plan, but my personal plan. Why do I think I want to hold a little bit of Bitcoin? And if I really like Bitcoin, then maybe I get into Ether. And then maybe I even get into some of the other ones that PayPal offers, because I like those and they resonate with me. And then going from there, going on to some of the exchanges and saying, okay, so Coinbase or one of these other exchanges, list these other tokens. Let's learn a little bit about them. Maybe I want to put a little bit each one of these tokens as a venture bet. And then, family office or an institution might go into, hey, okay, well, I want to upgrade. So maybe I go into something like a prime brokerage account. Like right now, Coinbase has Coinbase Prime, and you go into something like that. And then from there, when you get into the seven figures, you really want to think about deep cold storage and really doing research on that and saying, okay, well, what do I need to know about deep cold storage? Just because they're calling it deep cold storage, are they all created equal? Because some of them use FSMA-like security. And I'm not an expert on FSMA, but the way I look at it is like this. So Fort Knox, where they store the gold, is probably the most secure place in all of the world. So FSMA may not be 100% as secure as Fort Knox, because I'm sure they have some secret things they do there that none of us know about. But outside of being Fort Knox, it's the most secure you can possibly get. And even things like FSMA do have some risks. Natural disasters. I mean, if there's an earthquake or some kind of crazy sinkhole or just something we haven't thought about with a natural disaster, well, of course, that could be a risk to deep cold storage. But I always look at the probabilities. What's the probability of that? And a lot of people talk about the risk in just Bitcoin in general. I actually think the biggest risk no one ever talks about is the grid going down and all the power going out. Because, then it would shut all the miners down. You wouldn't be able to verify the blockchain, things like that. So really, electricity going down could be the biggest risk to Bitcoin. And I know they have things now with satellites and people are working on things like that in mesh networks. But until that's truly robust, I really think that electricity in the grid is actually one of the biggest risks no one ever talks about.
Yeah, that's a great point. And yes, they're kind of working on that in a variety of perspectives, including the satellites that James noted. I'm going to take a little bit of a step back, do a pinch of a recap, then ask James a specific question on wallets. So yeah, again, an exchange like Coinbase that is now, going public, they got a lot of oversight. They're well capitalized. I would feel more and more comfortable, even though technically it's street name, in terms of potentially, and as long as I'm really, really careful with my personal security and password, probably even having more than 2,500 on that type of an exchange. And that's probably safer, especially if some of you are not overly adept at technology and the wallet issues, then, some hot and even hardware wallets, I could argue. And they also have insurance. But again, if your phone is the one that gets hacked, and there's lots of things that could go wrong there, then, you're out of luck. So that next level up, some people say, is the hot wallet, but that is definitely subject to risk of getting cyber attack. But again, if you wanted to have a hot wallet or two with $100, $1,000 on it, just in case money, it probably wouldn't be the worst thing in the world. And you get a little bit of the experience of doing it. Then you go up to hardware, which is not directly per se via your computer. It's really on a computer, but so not directly to the internet, but there's a lot of buts there. Has that computer ever been used to connect to the internet? Could there be malware on it? Could it be attacked? And I don't think that's spoken enough about in the industry. Again, hardware wallets could be an option and, an arsenal for storage. But I think it gets a little bit overblown as being that it's like perfect or near perfect. James, if you don't mind, go a little bit into some of the potential risk of the hardware wallet.
Yeah, I think the biggest one is just that you have to connect to the internet sometimes. So anytime you have to connect to the internet, that's a big risk. But
so to upgrade my software?
Right. Some of them you have to upgrade the firmware, they call it.
Yeah, firmware.
And so I would think that's a risk. Because you would be going on the internet, and let's just say somehow some malware got in there. So your cryptocurrency would still be there, but then when you go to actually, say, put it on an exchange or sell it, and you send it to another address, they could possibly intercept it somehow. So you think you're sending it to one address, but it's kind of like an interception, like think in football, someone throws a pass, and the safety runs in front and grabs it. So you think you're sending it to this address, and you're really sending it to another address that changes at the last second. You don't really know it. I mean, a lot of people say that the risk of that is very low, that couldn't happen. But I always say that with technology these days, even if the risk is like almost zero now, someone's going to think of a way to make it that the risk is greater. So I'm not saying be scared and panicked and lose sleep over these things. Just be mindful of all of these things that could happen. I mean, it's just like even with the paper wallet nowadays, because the paper wallet in theory seems great. But now if you have to go on a website and get it, I mean, you don't know who's behind that website, or if that website's been compromised and they don't know it.
And
so
what is the risk?
Things like that, just be mindful.
What is the risk? And maybe it's more with hardware, as you noted, for like seed phrases. If you could talk a little bit about the advantages of that, but potentially, where that could get hacked or where quantum could come into play a little bit with that in the future.
Right. So I would say, too, when people buy these hardware wallets, just make sure it's not a pre-initialized hardware wallet, because even though that might seem easier to get up and going, if someone's already initialized it, you don't know what's going on with that. And then also, too, there was allegedly, I don't have any proof of this, but I remember reading someone had a hardware wallet that they were selling, and it already had a pre-selected set of recovery words. So when you get your hardware wallet, you want to make sure you're the one that generates these seed phrases on the device, that you do it yourself. Because if it's been done by somebody else and the words are pre-selected, obviously somebody that's pre-selected would know your phrase.
What is the seed phrase? James, just to back up a little bit for those that don't know, what is the seed phrase?
So it's generally, the reason I say generally, because someone may change it someday, but it's 12 to 24 words, and they're random words. Like they seemingly make no sense. So they're generated at random. I mean, they could be words like smart card, store, slow, train, lessons that seemingly make no reference to each other. That's the whole idea of it. So your 12 to 24 words, if you were ever to, like, say, lose your hardware device, you could then get another hardware device or even like a hot wallet or something and enter your seed phrase and import that, and it would import your wallet and all your cryptocurrency would be there. So that's kind of the easiest way I think about thinking about a seed phrase. So it's really like almost like a backup, recovery, things of that nature.
Now, how about the people that say, listen, I have a hardware wallet, I'm really careful. You would probably say I'd keep it hardware on a computer that has never been connected and will never be connected to the internet. But if you need to update the hardware, then that becomes difficult. But my bigger point was, how about the people that are very careful with their passwords, with their Wi-Fi, and have a VPN? I'm assuming that ramps up the level of security, but that's not, even that's not going to be 100% perfect, potentially.
Right. So I would say that definitely ramps up your security. And I always say too, not just like with cryptocurrencies or anything, but in any kind of technology, and we're really learning this with the work at home, that cybersecurity is an ongoing process. So you'll just put up your security walls and say, I'm done, because obviously the bad actors, the hackers, the people of that nature are going to keep evolving. So you have to keep evolving and keep kind of evaluating your own personal security network and saying, am I keeping up with the latest and greatest threats? Am I keeping the probability of myself being compromised low? Because I always say, you're only as strong as the weakest link in the entire chain. So if there's any weak links anywhere that may not be visible or you're thinking of, you're exposed. I actually think that the larger the company is, the more exposed they are by the weakest links, and they just don't realize it. That's why you always hear these big hacks in the news, like, Equifax and these things like that. And you're like, oh my God, how can a corporation with all that money and all those resources be hacked? Because they're so big, they're more vulnerable. I mean, the more employees you have, the more vulnerable you are. I mean, theoretically, someone could SIM hack an employee's cell phone to gain access to some kind of password or some kind of network at a very big corporation. So the bigger you are, in some ways, the more vulnerable you are. At least as an individual, you have more control if you're just one or two or three people in a family over your cybersecurity. And then as you go into, say, family offices and institutions, you have more resources to secure yourself, but you also have more, hands in the pot that could be exposed. So it's kind of balancing of that. That's kind of the way I look at it. And I actually think all these people go around worrying about quantum computing being a threat to the Bitcoin blockchain. I think the risk of that is very, very, very low. It goes back to me saying when 99% of people think something is generally wrong, because there's an enormous amount of talent and smart people working on keeping that from ever happening. I think the biggest risk is actually quantum computing being able to figure out seed phrases and hitting, individual wallets and just taking the cryptocurrency from each wallet. I think that's a bigger risk than actually the entire blockchain going down because of cyber.
I mean, definitely, I completely agree with you about that. And there's way more money not in Bitcoin, in other more classic and traditional, that is going to be much, much more lower hanging fruit because it doesn't have the protocols of blockchain and the complexities in the example of Bitcoin and why it's so great from that perspective. I probably shouldn't dive too deeply into this rabbit hole, but there are some people that say, listen, I'm really careful on my phone. I have great passwords that really, I have a dual authentication, blah, blah, blah. That's all great. And you're better off being more careful and secure than not. But that is not 100% either, because of something that you mentioned earlier, the potential of a SIM attack. Again, I don't want to make this overly technical, but explain what that is to people, on their phone.
Right, so that's highly evolving, the SIM attack, because years ago, I remember I've been SIM attacked a number of times, and when you first even reported it to authorities or whatever, they had no idea what you were talking about. But now, because the media is out there, there's been more security. But now a lot of people don't realize people can SIM attack you by sending an SMS to your phone. So be very careful if you get a random SMS to even respond to it, and never ever click on any links or anything in SMS, even like by accident. And I would imagine, too, now via email, some things probably people would have a way to access your phone if you hit the wrong link, kind of through some malware. And I know iOS is very hard to get malware on, but I would just be very careful because I always look at it this way. With any kind of hardware, whether it be a hardware, crypto wallet, your phone, you have to be careful of people coming in through the back door. And we don't necessarily know what those backdoor threats are because, it's the unknown unknowns that get you in financial markets. So I would imagine it's the unknown unknowns that get you also in cybersecurity and personal security and anything like that. And I think one of your guests, BK, even had a great comment. He said it's the bus you don't see coming that hits you or something like that gets you. So he's always looking for those bus he doesn't see coming. And there's always going to be threats in cybersecurity, always.
Now, some of them use what is classically the paper wallet or hardware wallet, but I gotta give to the brethren that's a maximalist or a hardcore libertarian, is very untrusting of banks, institutions, even custodians. What would be probably, besides, again, diversity of devices, being very careful, password, VPN, what would be the way where they could like have the QR code, they print it out on a computer that was never connected to the internet, and maybe they keep the key or the phrase either in their head or on a piece of paper. And again, in theory, they could travel the world as a self-sovereign and have access to their capital. How would someone go about that? What are some of the steps they could take? And even then, there is risk. Has that computer ever been connected to the internet? How did you get that QR code? What happens if people know that you own Bitcoin and suppose you get kidnapped? So again, there's not going to be any one thing that is perfect, but to show our maximalist and libertarian brothers a little bit of love, what's a way potentially that could be a little extra safe from that perspective?
Right. So the paper wallet has the QR code, but nowadays you have to go to a certain website to generate these paper wallets. And I'm just very nervous about those type of things.
Yeah.
I mean, technically, if someone has some of the software they could use, I think through Linux and Raspberry Pi, you can put stuff on a CD and generate things that way. Because there actually used to be CD type storage. I forget the official name. I think we talked about it in the paper. But I would be very careful. I would say go back to simplest is always best. So if someone truly wants to do it that way and want to take the risk, there's websites you can find that you can generate a paper wallet. I would just be very, very careful with that. I really would prefer the Bitcoin or crypto ATM to do that nowadays. And then you have your QR code. You can, they say don't take a picture of it. So the way obviously don't take a picture of it on your phone because, that's connected to the internet. Don't email it to yourself and all those good things because they really expose you on the internet. But I guess theoretically, you could take an old school, remember those digital cameras that aren't connected to the internet? You could take a picture of your paper wallet with the QR code, put the QR code in, say, a safe deposit box, and you could even break it up and have several different paper wallets, maybe one you have hidden somewhere in like a safe-proof box at home, one at a bank that has different amounts of cryptocurrency, not the same wallet. Take a picture of the one that's at the bank with an old school digital wallet, if you can, not digital wallet, but digital camera, if you can even get them. And it has a USB, and then put that USB drive into your computer and store it on a computer that never goes to the internet. So I mean like a very, very, very old computer that never, ever will go on the internet again. So if you have kids or something or a wife, make sure they don't go to the internet on that computer. So now that's stored on that desktop drive. And then if, let's say, there was ever, I don't know, civil war, chaos, and you had to get out of Dodge, for lack of a better term, then at that point you have to go back into the system and expose yourself. You could take, like, say if it's Bitcoin, a hot wallet and scan the QR code off your desktop, fire it up and scan it. But this is a desktop that's never been exposed to the internet again. And then that Bitcoin could be loaded into your hot wallet where you're now exposed, but obviously you need to do that to get out of Dodge. Now, obviously you could take the desktop with you. And I would also recommend too, since it's just that picture, taking a new thumb drive, never been used for anything else, and also backing up that picture there. The reason I say that is because these paper wallets, what if the paper wears out? Paper gets old. What if you can no longer scan that QR code or you can't read the numbers anymore? I mean, if that wears out, and I'm sure over maybe, I don't know the exact time, but over a decade or decades, I'm sure there's ways to try to preserve the paper, but it's eventually going to wear out. So nothing is riskless. And then you get like some of these people that say, oh, I'm going to memorize the keys and all this stuff in my head. Well, that's awesome if you can do that. But over time, what if you forget one of the numbers and the only place it is in your head? So I always say then you become a risk to yourself. The biggest risk is yourself in that case. That's why, too, a lot of people are against like the squares and them, that you don't hold your keys. But remember, you're a risk to yourself with some of these keys, too, losing your passwords, losing your keys. So that's why I'm really into that weighted barbell approach. And as time moves on and regulation happens with more KYC and stuff like this, who knows where the regulation is going to go. But I have a feeling that any of these self-custody wallets, that in order to move that money eventually, if that wallet isn't forced to KYC by law, you're actually going to have to send it to, like, say, an intermediate wallet that KYCs you before you can go back into the system and spend the cryptocurrency or go into an exchange or things like that. So it's either going to be sending from one of those wallets to an exchange that KYCs you, or if I want to do peer-to-peer, say from me to you, I'm going to have to go to some kind of intermediary wallet that KYCs the both of us. And there's this thing, without getting too deep into the weeds, called chain analysis, where they can almost, take the origin of that particular Bitcoin and trace it back to when it was mined. Now, there's some debate whether or not you can go back how far, like some of the original cryptocurrencies, that you could truly trace it. So even if you can't today, I have a theory that with enough time and enough technology being advanced, that they're going to be able to trace every piece of crypto that was ever originated back to its origin.
Yeah, I mean, wow. That was, by the way, an amazing and really deep overview. And unfortunately, I probably could see families like their heads swimming like, oh my God, this is just so complicated. You could break it down, read the paper, do your own diligence and research. It's not quite as bad as what I'm describing, but you probably want to have a diversity of options. I'll take a little bit of a side note for a second, because if you're a significant family or family office or institutional level investor, even with listening to this, doing some diligence, reading the white paper, you may say wow, this is really a lot. We didn't even get into the ecosystem of DeFi, NFTs, and all the potential that's happening in that. James and I have initiated something that basically is a private consulting service that will really, really help on a lot of these issues that I think many of you, especially at a larger scale purchase, are going to need. Now, my members of the Family Office Association, as significant families or single family offices, will get significantly beneficial pricing and benefits, but it will be available selectively to non-members, but that would be at a different price and a different premium. So simply stay tuned or reach out to me. We'll have more to follow on that. Okay, enough of the sidebar. So what some of you are probably thinking, like, wow, that's really complicated what Angelo and James is talking about there. Maybe not as much the buying, but in terms of, the security, in terms of storage. So some of you are probably saying, oh, I mean, is there an ETF out there that would be so much easier like there is for the gold ETF? Not yet, but inevitably, at least here in the US, it's coming. I'm going to take a guess. Come on. Eventually, it's going to get through in 2021 or 2022. I'm 99% sure. And then you could imagine a BlackRock or an organization like that. And that would make it super, super, super easy. Now, the argument against that is going to be what the hardcore gold folks would say about the gold ETF versus physical ownership. So that would not necessarily be incorrect. You're going to have to do your own diligence and make your own decision. But at the moment, that's not even an option. So now we're getting down to really what this comes down to for relatively larger purchases. James may say $1 million. I'm even going to say maybe 100 or 200,000. And that is, what's an easier way for me to buy and to store? And we hinted at both of them already. So at that level, quasi tiny institutional, over-the-counter services, so all the exchanges that we noted and others, and I would only use in the US regulated exchanges. You want to be very careful here. But over-the-counter, you get much, much more personalized service. You actually get someone to talk to. So they call it an OTC exchange, and Coinbase and Kraken and the others that I noted and many others have that. So that is by far going to be the most common option for larger purchases. And then that segues into custody. So that would be, you would want to do what's called deep cold storage. Like James said, not every deep cold storage is the same. Some are better than others. But what are some of the custodians that are in that community? NYDIG, NYDIG. They have an ownership stake from Mass Mutual and JP Morgan. That's the one where Mass Mutual did their $100 million purchase and storing it in deep cold storage using NYDIG. NYDIG probably has more, custodial of the keys by a wide margin than anyone else. And they have really legitimate deep cold storage. Do your own diligence. Fidelity Digital, Anchorage, Coinbase custody. Those are examples of some others. Again, things change. Insurance gets a little complicated, not quite as good as we would like it to be, but you're going to have to do your own diligence to really dive into what could be a good fit. And maybe for some of you at truly large amounts, having a diversity of different high-level, true deep cold storage custodians that you would use in conjunction with some of the other more liquid direct to you. And if you're afraid about things going to hell in a handbasket, you'll probably see that coming and have the opportunity to move some of that, the resources in the deep cold storage as you could. Now, like James said, suppose something happens to one of these organizations. Suppose these are deep underground, very private bunkers, and there's an earthquake or a sinkhole. And then you're going to want to really understand the insurance, which is going to be more limited than it should be. But again, you're going to have to do your own diligence on that like we did. Just things are changing so rapidly. There is not a one perfect solution. Now, for those of you that until there's an ETF or you just don't even want to go through the OTC and custody of deep cold storage, and I would not understand why not, by the way, but let's just make that assumption. There are still other ways to get exposure to Bitcoin and the community. And probably the most prominent out there is Barry Silbert's, or one of his organizations, Grayscale Bitcoin Trust, and I guess even Bitwise. James, do you want to give a brief overview to kind of the advantage as the ease of use of Grayscale Bitcoin Trust, and maybe what's going to be a challenge on the expense side, I guess you could say?
Sure. I was going to make a comment on cold storage real quick too, deep cold storage. Sure. That the important thing is, even though you can find all the providers online and they're happy to take your call, it's really, really important to know what kind of questions to ask them when you're vetting them. And these things are going to evolve and change over time. And also keep in mind too, that all these storage providers don't store every token in deep cold storage because there's technology upgrades that would be needed to hold certain tokens, especially if it's on a different blockchain than the ones that they custody currently. So you really have to know what questions to ask, know the cost, know the risk and rewards, the pluses and the minuses. So that's why it's really valuable to have somebody help you with this, almost kind of like hold your hand, just so you know what to ask, when you're building relationships with these different providers and things like that. Now, as far as Grayscale goes, the great thing about that is it's a closed-end fund, and admittedly, it does trade at a premium to the net asset value, and so does Bitwise. But the thing about these closed-end funds that are great is you can buy them in your retirement account. It's easy to have that way, and you don't have to worry about having a self-directed IRA and all the ramifications of that. And it's just as easy as buying shares. So a lot of people, they're like, I know shares. I go in my Fidelity account, and I buy stock in Apple. So I'll buy shares in the Grayscale Bitcoin Trust. I mean, totally fine. And also, too, people that are accredited investors and qualified purchasers and institutions, through Bitwise, you can actually call them up and buy it at the net asset value as of right now until they close that off. Because right now, if you buy it on exchange, you're paying a massive premium. Now, Grayscale used to have where you could call them up and buy directly, but I just recently read that they actually stopped purchases for now because a lot of the thing is there's pluses and minuses. So obviously, if you're getting at the net asset value when you buy directly, you can't just sell it immediately and say, thanks for the arbitrage profit. That would be awesome, right? But they have a lockup period. So I guess they change over time how long the lockup is. I mean, I've heard different things, 6 months. I've heard other things a year. So it probably changes depending on the situation and how the market's going and when you made the purchase. But Grayscale is definitely a great way to get exposure to Bitcoin via shares. And a lot of people, too, don't think about it this way. I mean, another easy way, and this isn't, a recommendation as far as investments because I'm not an RIA, but you could just buy MicroStrategy stock because they have a large treasury of Bitcoin. You could buy Square because they're holding Bitcoin. You could buy some of the Bitcoin miners that are publicly traded, but just be careful and size yourself accordingly because the market caps are smaller. And the liquidity is smaller as far as the amount of shares that trade. But it's rising greatly. Obviously, as the price rises, the market cap rises, these miners, and the liquidity rises as the shares trade more and more and more, and there's more interest. But just be mindful of that. And a lot of the miners actually have more beta than the Bitcoin. So the Bitcoin miners that are publicly traded are actually outperforming Bitcoin year to date as far as their price appreciation. So shares is definitely one way to go. I always say take another weighted barbell approach. Have some in the actual Bitcoin. Maybe even delve into managed accounts with things like options on Bitcoin futures if you're an institution, the family office. Maybe have a little bit in some of these closed-end funds. And there's also ETFs in Canada for Ethereum, and there's other ways to do it. Like I just heard, I think a couple of days ago, that I think it's Skybridge, the guy Anthony Scaramucci, I hope I'm pronouncing his name right. They actually are now offering a Bitcoin fund with LPs, and their reason that they're saying to use them is because their expense ratio is like 0.75, so I guess 3/4 of a basis point, which versus say something like a Grayscale, it's like 2%. And also, I believe Skybridge said they're going to run their own node, and they're putting $25 million of their own firm's capital into it before it launches. So they're going to put the first money in. And it's true, too, all of these providers, like the Grayscale, run their own node, because obviously to get the Bitcoin, you want to have your own mining operation to get the best price and things of that nature and not have to worry about just getting it from others.
Yeah, I mean, I agree with you about, diversity, and I know it sounds like a lot. And Anthony Scaramucci is very thoughtful, has been, in the alternative investments industry for a number of years. And what they appears to be doing it right. So those are all things that, do need to be explored. You mentioned that it's, an option, a future on the CME that potentially is something to explore. And related to what you just said about Scaramucci, broadly speaking, there are, for sure, quote unquote, cryptocurrency and digital assets innovation hedge funds. And probably the most prominent is iconic trader Dan Morehead, the CEO of Pantera. So, and he does great investment letters as well. So there are options to explore. If your head is spinning and say, listen, I'm used to being an LP, a limited partner in more of a hedge fund format. I don't want to worry about purchasing, custody, and storage. Then yeah, I mean, there's a layer of fees, I guess you could say, but now you're dealing with quote unquote professionals, and this may simply be a format that you're going to be more comfortable with. So at minimum, and we write about it in the paper, but you should for sure have a level of familiarity with it. So like, wow, I mean, that was a real lot there that we covered. It probably was like coming at people like a fire hose. I want to go back a little bit to like, who's getting involved in the greater acceptance in the community? I already mentioned Paul Tudor Jones, and if you could look up the letter that he did, I believe it was May of 2020, and Lorenzo Giordani from his organization, who has an amazing background as well, basically stating that he did a, significant macro analysis and believes that simply the, gold is good too and other things, but the fastest source is likely, to be Bitcoin. We already mentioned, Stan Druckenmiller, and others, from Bill Miller to Kathy Wood to people that are active, like I mentioned, Dan Morehead, a Mike Novogratz, a Barry Silbert, a John Burbank, a Tim Draper. There's a lot out there. I mean, I did an interview with, former Goldman alum and hedge fund manager Raoul Paul, who's very thoughtful, very well known from the work that he does in Real Vision, where, and again, it could change at any moment, that he has a lot of his liquid net worth in Bitcoin. And a lot of these iconic macro traders, they started to take institutional capital in their hedge funds, especially pensions, that wanted less volatility, that wanted just more consistent returns. But that took the juice out of what they accomplished before they got too big and they became more asset gatherers. But now some of them are just, not doing the hedge fund anymore. They're running their own family offices, and they're getting back to their deeper macro roots and being more strategic and more tactical in terms of their approach, and arguably taking more risk, but with the potential of greater returns. I mentioned before about Goldman and Sachs and JP Morgan, and I'm sure others having fast growing, crypto and digital asset divisions, about new regulations, about crypto banks in Wyoming. And that's been really amazing. About incoming US Senator in Wyoming, actually, Cynthia Loomis, of owning Bitcoin and being a great advocate of that community, of Northern Trust. I mean, we mentioned Mass Mutual buying $100 million for their treasury, but Northern Trust, an ultra conservative, well-respected custodian, is going to be involved in working on custodial options. So we're going to see the custodial options really expand, sooner rather than later. I mentioned with Ferguson, And, I think that, even a newer thought leader and very thoughtful, he's almost a philosopher in the world of Bitcoin and crypto, is Robert Breedlove, who's the CEO and CIO of Parallax Digital. And he's going to be on my podcast next week. So by the time you guys hear this, I'll probably have that up publicly in my YouTube. So take a look for that. But he states, and James has mentioned this as well, that Bitcoin is a non-counterparty insurance policy on the legacy technology of central banking. This policy becomes more valuable the more fiat currency is produced, a true barometer for the failure of the legacy fiat system. James, why don't we transition? And again, we are going to have to be a little mindful of time because we have a fair amount to cover. But I do want to cover somewhat, Ether, ETH, Ethereum. If you could give the audience a bit of an overview, that would be wonderful.
Right, so Ethereum is the second largest market cap in cryptocurrency today, obviously dwarfed by Bitcoin. But Ethereum is basically the computing platform that most of the, they call them dApps, decentralized applications, are being built on. Now, there are other platforms where there are applications being built on, so it's not the only one. But right now, Ethereum is the leader. So the majority of DeFi has been built on top of the Ethereum blockchain. And I think that's really important too, because that makes kind of Ethereum is moving into the dominant digital network. Is this the underpinnings basically for decentralized finance? So some could even argue that the Ether token is the reserve currency of DeFi, just the way that Bitcoin is the reserve currency of all cryptocurrency. Now people say, how can you say reserve currency? Because in Bitcoin, people trade in pairs just like in currency. So, Bitcoin versus another pair. You could sell, Bitcoin versus Ether, Bitcoin versus Stellar, Bitcoin versus XRP, if your trading platform allows that pair. But they all trade in pairs. So the way I look at it is Bitcoin is the reserve currency of all cryptocurrencies, and Ethereum is the reserve currency of DeFi, at least as of today. And that's really important because the more people who build on Ethereum, in theory, the more valuable the network gets. So that may not necessarily translate to the price, but it probably will, because in Ethereum, when you kind of engage, for lack of a better term, with these decentralized apps, you have to actually pay gas fees. So you actually have to buy Ethereum in order to pay the gas. Now, there are people working on other platforms where you wouldn't use Ethereum as the gas, that you would use their token or pay in USDC, different kind of ways. But until that happens, Ether is going to be the dominant currency in that. And I always say, too, you can't fork community. So even if someone has a better technology, it's going to be the one who has the most adoption. Whoever gets the most adoption and the most robust community is going to be the one that wins. That's another reason why Bitcoin is so valuable. They have the largest community, the most robust community, and they have the greatest adoption. And then second to that would be Ethereum blockchain.
Yeah, that's, all good points. And again, we don't have time to do a super, super deep dive. And there even is continuous upgrades and improvements in the networks. I guess Taproot with Bitcoin and Beacon for Ethereum. We go into a little deeper dive in the paper. But again, this is something to do your own diligence, your own research. And again, it is something that James and I will consult on and simply have a chance to reach out to me relative to being a conduit about that. But to understand this ecosystem, you should be very familiar with it. There are aspects of Ethereum that are truly mind-boggling in terms of what it does as a smart contract blockchain. That is incredibly impressive, and it's gained already tremendous traction. Like James said, it may very well be kind of the real anchor of DeFi, which could be just huge. And there are some people that think it's even a better asymmetrical bet, quote unquote, than Bitcoin. Now, again, you're going to have to do your own diligence and make your own decision and your own diversity, your own limitations of what allocation should be and all that. But simply said, something to explore. It's a little indirect relative to what James said, but it does help to answer, kind of the question of, will another cryptocurrency come along to replace Bitcoin, so to speak, as the newer and faster cryptocurrency? Well, in theory, anything is possible, but look at the power of that network. There's different statistics, somewhere between 60 to 100 million people, and it's growing, it's not shrinking, are utilizing Bitcoin. And there's many people, just like fans of Tesla, that are evangelists that are maximalist, that, they're going to be in it, quote unquote, forever. Now, sure, is it volatile? Of course. But to think that it's going to be easily displaced, it's such a powerful blockchain and so ultra secure, a little slow, and maybe not going to be the best thing for tiny purchases. I get it. Its utilization purely as everyday monetary transaction. It's not going to be its strong suit, although there are some developments that are adapting that need to be followed, but that may also make that fork or whatever they're going to do potentially that in the future be a little bit less secure than the Bitcoin that we know it. So again, these are all things to keep abreast on, but you cannot underestimate the network effect of Bitcoin. It is dominant and growing. And again, that goes a little bit to intrinsic value, and the value is something that, again, you're going to have to do your own diligence, make your own decisions on. James, let's also go a little bit quickly, but at least cover it somewhat to some other aspects of the ecosystem. Let's talk a little bit about stable coins.
Yeah, great. And that's great too that you mentioned that now, because stable coins is one of the great inventions that happened because of the Ethereum blockchain. So stable coins, I just basically look at them pretty simple. They're basically pegged to an asset or a basket of assets, but most commonly they're pegged, 1-to-1 to say like the US dollar, like USDC. So for every USDC created, there's $1 somewhere in a bank backing it. That's the easiest way to think about it.
Yeah, that's okay. Since you brought that up, if you want to talk a little bit about, what is a USDC and, how that interplays, do you want to bring up anything with Circle and kind of what's behind that and how this whole ecosystem may play out?
Right. So I think this really leads us into programmable money over IP, because since smart contracts are involved, you could program anything you want. You could program that, on a certain date and time for Christmas, December 25th, tomorrow, that one of your family members or whatever is going to receive this payment via a stable coin. It could be programmed in there. And also you could timestamp money in ways that say, okay, if someone gets a stable coin, for instance, say in, a central bank digital currency, that you have, say, 90 days to spend so much. And not only to spend so much, but you have to only use so much of it for food. So it knows that you bought food. It knows that you bought healthcare. It knows that you bought education. So it can truly be even customized, because if the central banks gives everyone, say, their own central bank digital wallet, for lack of a better term, like individuals. So you and I, every person in the entire world, depending on where they live, would have their own central bank digital currency wallet from their own local central bank. They could literally just communicate with us. Like I remember hearing, I think it was yesterday or the day before, some kind of new stimulus payment or something like that. And now they're trying to raise the amount or something, that instead of having to wait for them, I don't know if they still mail paper checks, but someone said mail paper checks. I don't know if that's figurative or not. That instead of having people have to get them in the mail or have some kind of like, I don't know if they call it ACH or direct deposit in their bank account, literally they could just send it to your wallet, like instantaneously, settle in minutes or seconds even. And they could have requirements, your own personal kind of banking thing. So in your central bank digital wallet, your savings, they could say, okay, well, this guy is saving $1 million in cash. Well, we're going to put bad incentives on that. If you keep $1 million, then we're going to give you a negative 10% interest rate or something like that. So that's going to force somebody to say, wow, I can't keep $1 million in cash lying around in my bank account, so to speak, which would be their central bank digital wallet. I'm going to put that money in the stock market or in real estate or something like that in order to avoid, this penalty, this 10% negative interest rate. And then someone else, they could say, hey, you only have $1,000 in your savings account. We understand you have to have like some rainy day money. For you, 0% interest rate. And I really think the reason that they don't do 0% interest rates in the system we have now with the tools we have today is for two reasons. One, they don't want to destroy the banking system, but also pension funds. Pension funds are struggling to meet that hurdle rate and things like that. So you can't give them a negative interest rate to pension funds because that would hurt retirees. But what you could do with this, central bank digital currencies, these specialized programmable money and programmable smart wallets, you could say, okay, the pension funds, they can have, billions of dollars in cash to meet their demands and make their payments and endowments, but their interest rate is still 0. It's not negative. And for banks, they can create special ways and test out different experiments on ways to really unroll this and kind of get it out to the public and find out what works and what doesn't. What's the consequences? What's the unintended consequences? How are people reacting? That way they don't destroy the banking system as we know it. Because I actually think they're going to go to tokenized banknotes, where banks can actually lend out money themselves. So they're kind of creating the money without the Federal Reserve printing the money through tokenized banknotes and have different interest rates. Because I think I was hearing yesterday or reading somewhere that even though interest rates are at record lows as far as the Fed and housing, that on credit cards, the interest rates are at record high, even higher than they were in the 70s during Paul Volcker's time. I don't know if that's true, but I read that somewhere.
Yeah, like interesting comments. I mean, that's, a lot that you covered there, and it was great. And taking a little bit of a step back, stable coins really attempt to bridge the gap, I guess you could say, between fiat currencies and cryptocurrencies. It could be pegged to an asset or basket of securities. And I would definitely, look into what Visa is doing, adding USDC to its payment network through a partnership with Circle, and, look them up, and they're doing intriguing things. Kind of fintech behind the reserve, quote unquote, backed stable coin, and living up to that word stable coin looks to kind of stabilize, I guess I would say, some of the difference. So you did jump into central bank digital currencies. That was a great perspective. That probably saves me the time from spending a deeper dive into it. But again, I want people to realize you are kidding me if you think that is not coming. So are we going to stay in an analog world? No. Once digital is out there, and what's happening now with the blockchain, or in the case of central bank digital currencies, not really a cryptocurrency, but more a centralized exchange, this is absolutely coming. It may take a couple of years. I'm not saying it's going to happen next year or the year after. I don't know, 3, 5 to 7 years. And this has a beauty to it. It is wickedly efficient. It will change the dynamics of taxation and many other aspects and make things way, way more efficient. But there absolutely is a big brother element to it, because on their centralized network, they could basically see everything. And why it's called programmable money as well is it creates the opportunity to charge different people different interest rates, to penalize people for having too much money held in their wallet and savings and not into, quote unquote, the stock market. I mean, who knows what governments could do? And maybe some of it's good, but I am saying just it'll be interesting. And we speak about it in the paper. The CEO of Citi came out and said that they're specifically working with a foreign government on creating that foreign government central bank currency. Again, don't think banks, the brands we all know, are going to be left out of this. They're not. They'll adapt, and they'll be involved from their power, influence, and clout perspective, as well as some of their talent, infrastructure, and what they're doing. That absolutely will happen. I mean, is that potentially a competitor to Bitcoin? But again, it's a centralized network. It's programmable money. That's completely different than a decentralized network like Bitcoin. Let's just give like a second, maybe a little more, James, that besides Bitcoin and ETH, of course, there's thousands of other cryptocurrencies. If you could talk a little bit about the breadth of the ecosystem.
Yeah, so basically in the DeFi market, their philosophy, I kind of say, it's DeFi, like a new monetary philosophy. And their main philosophy is interoperability. So they want everything to be able to kind of through what they call the money Legos, to be able to assemble together and then unassemble, almost like toy Legos. So you could have your own decentralized finance app that you build. I could have mine, and we could hook them together and do something that both of them don't do by themselves. And then we could unhook and kind of Lego onto another building block of something else and do something else completely different. So this is kind of revolutionary. It's kind of off-ramping and on-ramping for different functions. So I think this is incredible, and it's going to have incredible innovation, things we never thought of, because people just keep building things and building things. They're figuring out different ways to lend via these things with interest rate 0, where people can earn a yield. There's ways to tokenize different things. And then we have, non-fungible tokens. People are thinking of different uses of those, and that's all going to tie into DeFi. So I think the whole decentralized finance thing is kind of going to be revolutionary. And eventually what's going to happen is a lot of this stuff is going to happen behind the scenes where you don't even know it's DeFi, but you have an app and you just press it on your phone and it does all the stuff behind the scenes, kind of the way most things do with the internet. You don't even know what's going on, and you're happy not to know what's going on, but it just happens, and you're benefiting from the progress of technology.
Yeah, I mean, that got right into the next section that I was going to bring up in terms of DeFi. And again, we do talk about it in the paper. We do want to keep things moving, but that was, a pretty interesting perspective from yours. And there are, innovations born out of DeFi, like yield farming and liquidity mining, if you want to maybe give that a little bit of coverage so people have a little bit of a grounding as to what it is.
Yeah, so it's interesting because some people say, yield farming and liquidity mining mean the same thing. And the funny thing is, the way things are moving so fast, not only in like the blockchain space in general, but in DeFi, it might move 10x the speed of what it moves in the regular crypto space because things are changing every day. It's literally experiments in real time. I mean, it's just so crazy. But liquidity mining is just really simply earning the tokens and providing liquidity, for lending and things like that. But basically, people are pooling, and they get this thing called liquidity provider tokens as a reward. And as time goes on, this just keeps evolving and evolving. I mean, they're going to come up with more and more things. Now, even NFTs, they have things like that where you can get rewards for participating in different NFT platforms. I mean, it's just insane. And the total lock value in all of DeFi just keeps going higher and higher. I kind of like to think of it as kind of in traditional finance, they call it, AUM. So the TLV is kind of like the AUM, because you got to keep in mind too, as the value of something in AUM rises, like stocks, say the stock price rises, your AUM could go up or down just based on the stocks that you hold. But the same thing in decentralized finance, the tokens that are inside the total lock value, if the value of those tokens rises, the total lock value rises even without adding to it. And obviously it falls without subtracting to it if the value of the tokens fall. But there has been a great growth also in DeFi where more and more, tokens and money, for lack of a better term, value has been added into these vaults. So it's just kind of incredible the way all this is evolving, just in 1 year, even in 2020.
Shocking. And we're going to get to tokenization and NFTs and, art and give a brief definition, a little bit more than what we did in a second. But I want to take a little bit of that step back. Like there's lots. Again, you're getting the fire hose. There's so much information coming at you. It may just be overwhelming and eyes glazing over to some of you, but, listen to it again, read the white paper, do your diligence, do your research. If you miss out on this, then, think of the impact to your portfolio, but more than just your portfolio. What example did I give earlier about being 70 and possibly, some of us starting to live for another 20, 30, 40, 50 years? We're about to enter the era with central bank digital currencies and programmable money. I mean this a little tongue in cheek, but imagine being a billionaire. We have programmable money, and you don't know how to go to the store and buy a loaf of bread from your wallet. You have to ingratiate yourself and understand and immerse yourself into at least the basics. And if you don't, what are those around you? Your CIOs in your family office, or those that may be advisors that know nothing about this community? They're the ones advising you, doing no research or diligence on it, not being from this community or understanding it, and having open debate. Because again, I think the ultimate risk mitigation after forming your thesis is simply to limit exposure to, again, under 1% to maybe 1 or 3%, and maybe more than that as some of you get more comfortable. You're also going to be subject to charlatans that may take advantage of you if you're, stuck in a analog era in a new digital world. No matter who you are, you need to be familiar with these things because it's just coming. And I think it's going to be, in some ways, a tremendous opportunity from an investing and being interactive perspective with. Okay, I'll get off a little bit of the high horse there for a second, James. The future of tokenization, non-fungible tokens, and art. I'm going to let's maybe wrap up from this perspective with those three very quickly, back to back to back. What are they?
So in tokenization, you can basically use the blockchain to tokenize any kind of asset and turn it digital. So it can be used in many ways. Some people are going to use it to provenance things like art as kind of like a certificate of authentication or any kind of collectible. And then you could take a piece of real estate. Let's just say you own some commercial building, and you can basically digitize and fractionalize it and say you might sell 20% of it while you still have the other 80%, but you're holding them in tokens. So it gives you some kind of liquidity. And eventually there'll be some kind of, market or alternative trading system, which they do have alternative trading systems now, but they're just not very liquid. There's not a lot of activity. But in the future, there will be, where people are trading on these things. And eventually you may even be able to lend out the 80%, for example, of the tokens that you hold and earn an interest rate in a zero rate environment. Things like that. So it's basically giving you the opportunity and the ability to take previously illiquid assets and make them liquid due to blockchain technology. The same could be done with art, baseball cards, Michael Jordan sneakers, things of that nature. And then non-fungible tokens are pretty interesting things because it's kind of like ERC 721. You can make a one-of-a-kind piece of art on the blockchain, and it's only one. It's not like Ethereum where you can break it into many pieces. It's just one. And in the future, I believe there's going to be smart NFTs, which people are working on, and that term's thrown around loosely, that an artist will be able to have their digital signature in the art and it'll be able to flash. So you'll know that, hey, this really is that artist, and it's going to be really hard to counterfeit that. Not impossible, but really hard to do something like that. And I also believe, too, this is going to be great for as far as artists being compensated in the future. So this isn't available yet, but I think someone will come up with this. So when an artist creates a painting right now, obviously, they sell it, they get the money, and that's it. And then the next person sells it, they get their profits. But I believe there's going to become like a digital chain of custody that pays royalties back to the original artist, not only in art, but in music and even creating different collectibles, that the original creator will get like a residual. And it may be tiered. Like originally they'll have their sale and they'll get on the first sale from them to the next person, maybe like a 12% royalty. And then maybe just to use the halving example of Bitcoin, the next sale, they get 6%, and down the line until it reaches a really small amount. But in perpetuity, they will get, whoever holds the digital rights to their creation, which could even be another kind of token, they'll get a residual income in perpetuity from that art they create. So it won't be just created once and then someone else gets all the benefits later in appreciation. You'll get some benefit of the appreciation in perpetuity. And I really think the fractionalization and digitization of everything is kind of going to create, I guess, some innovation in ways we never, ever thought of. And one thing, too, I think it's important that no one ever mentions, that just in protocols we have today, what is that a claim on? Is that a claim on the technology of that protocol? Because some people mistake that as being like an ownership in a company. And now there's a big thing happening with the SEC with Ripple, where they're saying, some people thought buying XRP, they actually had ownership in Ripple, the software company, which they obviously don't. But people should realize, too, a lot of these companies have a regular parent company, the normal conventional way, and they may have a foundation that issued a cryptocurrency. And we also have a thing nowadays, too, called a digital autonomous organization, where some of these companies have a digital autonomous organization where they're saying, hey, we don't have any jurisdiction because our jurisdiction is truly digital. It's on the internet. So we're not like in the United States. We're not in Singapore. We're not in Hong Kong, et cetera. But they also have a parent company that has contracts with like Johnson & Johnson and Volvo and all these great companies we heard of. And people are like, wow, when they look on the website of this project, this company is awesome. That they're doing deals with Volvo or whoever. Well, yes, they are. That is true. But it's their parent company, not necessarily the digital autonomous organization as of today. Now, I don't have any true clarification that Johnson & Johnson didn't contract, for instance, with the digital autonomous organization, but I'd be willing to bet the probability is no lawyer in their right mind, corporate lawyer, is going to sign a contract with a digital autonomous organization where we don't know the rule of law.
Yeah, wow. I mean, you really threw a lot at us there. That was great. And yeah, I mean, I'm a big believer in some of these opportunities in the digital assets community. You just mentioned a couple of them. And again, I'm already starting to see some families be active investors and allocators, and finally starting to, move the needle a little bit, even if a relatively small percentage, it's increasing. I'll move on a little bit. I mean, there's other things we talk about in the paper. I'm not really going to give a lot of coverage on now, kind of the Bitcoin versus gold argument. I think Dan Tapiero, a deep thinker and thought leader and a believer like I am in both gold and Bitcoin, co-founder of 10T Holdings and co-founder of Gold Bullion International, he states, for me, Bitcoin is much bigger than gold. Bitcoin could be, and I think will be, that value protocol for the internet. Whereas gold is a store of value, Bitcoin is an entire network. One aspect of what Bitcoin is a store of value. I also recommend, and we give a significant quote from it, but you can look it up online, an excerpt, Bitcoin is better than gold for one simple reason. That's what it's called. And it's by Clem Chambers, senior contributor to Forbes. He wrote it in November of 2019. It was really, really good. So again, we do some pretty significant quotes from it in the paper, but feel free to look it up online and have a chance to check it out. Okay, I would like to talk somewhat about challenges, about the negatives and the risk of kind of Bitcoin and cryptocurrencies. And one, to me, the biggest risk is not educating yourself and forming a thesis, because you could miss out on something incredible here. And again, limit your exposure. Your risk mitigation is simply a tiny percentage until you're more and more comfortable. And do understand, absolutely, you could, I guess, you could lose everything. So you really do have to understand that. But in terms of more classically some of the risk, I'm not going to go too deeply into quantum. That is a risk on some level that is not there yet. And there are really smart people in Bitcoin and others that are working on it. And we talk about it in more detail in the paper by someone who's a quantum scientist and explains, certain precautions to take. But in theory, it is something to at least keep in the back of your mind. Again, nothing is perfect and there are risks. James, talk a little bit about, and again, a tiny risk, but again, I want to be fair and balanced here. The role of miners, what hash power means, and theoretically, if a lot of the miners are in whatever, China, Russia, which they are at the moment, what would happen if the government were to identify them and nationalize them? Would they be able to then do a 51% attack? If you could talk a little bit about that.
So in theory, yes. But I always say, too, what's their intention? So if their intention was just to destroy, the Bitcoin blockchain, I guess theoretically they could nationalize them or just make it illegal what they're doing and say, hey, we're confiscating your company, for lack of a better term. But I really think the biggest risk is just someone shutting off the electric power. But I always go back to, if someone shuts off the electric power, we have a lot more to worry about than Bitcoin blockchain. If the grid goes down or an attack on the grid, that'd be the last thing I'd worry about. I don't know about anybody else out there, because that would basically shut down the production of food. And once everything's connected to the internet, like self-driving cars and things, it would shut down everything. Even at this point, it would just shut down supply chains and things of that nature. So the Bitcoin blockchain would be the last thing I would worry about. And so, it is theoretically a risk, but I think there's much bigger risk. The first one would be the electric shutting down. And if I was a government, I would just shut down their electric if I just truly wanted to stop them. I wouldn't even nationalize them, just shut down their electric. And then another risk, too, is a DDoS attack. I think that's very low, too, but somebody could basically just have an analysis service attack on one of these blockchains and, just keep hitting it so it wouldn't operate correctly. But I think that would be very, very hard to do, but that's a risk. But even though nationalization is a risk, I don't really see that as being like a very big risk, because I think that a lot of governments are actually thinking of Bitcoin, believe it or not, as a friend, because they're going to be able to tax it. They're going to be able to use the technology in certain ways. And eventually, too, just building off of the innovation with things like the Ethereum blockchain, central bank digital currencies. They may decide, hey, let's tax every transaction in the world 12 decimal points out, because an ERC20 token can go out 18 decimal points. And maybe they don't take it the whole way and they just tax it 12 decimal points out. They're like, oh, well, that doesn't sound like much. But on every transaction in the entire world for the rest of time, that's an enormous amount of money. And you could even just have like a federal tax. Then you could have like local taxes take a 12. You could have all kinds of specialized taxes that seem really small. But when you add up every transaction in the history of man for the rest of time, that's enormous. And there's even benefits too. With taxation, they can make the tax system much more simpler. I've read there's like hundreds of thousands of pages in the tax book, and some of them kind of conflict each other because they were written so long ago and someone adds something, but they don't know what pages you want to delete it. Just simplifying everything would be incredible. So, there's benefits and risk. But I don't really think that the centralized of mining is as big a risk as everyone makes it, because it goes back to when everyone thinks it's a risk, there's a lot of smart people thinking of ways to kind of defend these type of risks.
Yeah, you bring up great points. And again, I want to be fair and balanced. I want to bring up that it's not a slam dunk. You want to make an asymmetrical bet from an asset allocation perspective, which is potentially what some of the charting and what some of the opportunity of this would show, but that's not without some level of risk. Now, you touched on it, but effectively government risk is one. I would say here in the US, now that we have these legendary institutional investors being active. We have organizations like Mass Mutual buying it. We have amazing organizations like Northern Trust getting involved in custody. We have Goldman and JP Morgan active in it. We have organizations like Fidelity and NYDIG and others that I noted. And we have how many users, how many millions of users here in the US that are fans and advocates, how many US politicians. Look at minimum incoming Cynthia Lummis, who I mentioned earlier, incoming senator for Wyoming, who's a tremendously knowledgeable and great advocate of it. Look at the number of people it employs. Look at their level of income, their status, their tech savvy. Look at Silicon Valley's interest. Are you telling me that we're just going to try to make it illegal? And by the way, it's covered by the First Amendment. I won't get into grave details. I actually do in the paper as to why, meaning our white paper. But yeah, you can make the argument the government could maybe call it a currency and a threat to the dollar and try to bypass that First Amendment argument. I mean, it's not theoretically impossible, but there's lots of tailwind behind that not happening, including politics. And what I noted earlier, the number of people it employs, the number of people that vote. Do you want them just to get up and go to Canada or go to some other country and bring technical innovation to that country while we go into the dark ages? I mean, the reality is, yeah, we have to be familiar it's potentially a threat and keep an eye on things. Now, probably easier is for them to tax it at a higher rate, and that will have a negative impact, of course, not approving an ETF and some things like that. But what I'm going to go back to a little bit, and I know the maximalists are going to, turn over a little bit at this comment, but the proposed Treasury regulation from a couple of days ago, yeah, there's aspects of it I'm not doing handstands about, but there's aspects of it that show me that it's kind of finally getting a real stamp of approval from the government. What's your take on that, James?
Yeah, so I think that obviously as individuals, nobody likes, further paperwork, further friction, further regulation. But the fact that we actually know what some of the regulation is going to be once it finally passes, I think it almost gives a green light or a stamp of approval to some of these big institutions. Okay, now it's safe for me to go in. And also RIAs and people like that too, that have a fiduciary duty. Now they have some kind of guidelines that we didn't have before. I think that's really, really important. And unfortunately, everything in life is a give or take. So, you have to give something to get something. And obviously the rules are kind of vague and how they're rolling this out, and nobody really knows how it's going to play out. And I'm sure there'll be unintended consequences. But I think by and large, as far as institutions go, it's a positive because Mass Mutual isn't the only insurance company that's in. I've heard, and I won't add them on here, and I have no proof, but I've heard from others, there's 5 or 6 insurance companies that actually have Bitcoin on their balance sheet, but haven't announced it because maybe they're still accumulating or maybe they don't want to announce it. I'm not sure of the reasons. But Mass Mutual is definitely not the only one.
No. And we're heading about to the home stretch now. There also are what I would call misconceptions about Bitcoin and sometimes other cryptocurrencies. We're not going to have a time to do a deep dive. And there's someone that I am a huge fan of that many of you are familiar with. I interviewed her on my podcast and my YouTube about a week or so ago. That is incredibly well-regarded investment strategist, Lynn, that's with one N, Lynn Alden, founder of Lynn Alden Investment Strategy. She's an incredible writer, and simply relative to that misconceptions, look her up and then pull up 7 misconceptions about Bitcoin. And by the way, she covers number 1, Bitcoin is a bubble. 2 is Bitcoin's intrinsic value is 0. And that is to me one of the more frustrating arguments that ill-informed people make. I'm actually going to read briefly from her on that. Bitcoin's utility is that it allows people to store value outside of any currency system in something with provable scarce units and to transport that value around the world. Its founder, Satoshi Nakamoto, solved the double spending problem and crafted a well-designed protocol that has scarce units that are tradable in a stateless and decentralized way. Briefly, she continues. In terms of utility, try bringing $250,000 worth of gold through an international airport versus bringing $250,000 worth of Bitcoin with you instead via a small digital wallet or via an app on your phone, or even just remembering a 12-word seed phrase. Some of the others, by the way, in case you're wondering, number 3, Bitcoin isn't scalable. 4, Bitcoin's waste energy. 5, Bitcoin is too volatile. 6, governments will ban Bitcoin. And 7, where to buy Bitcoin. She's great. Go and listen to my interview with her as well. And that was really so well written. I just do an incredibly brief recap here and recommend that you pull up via the hyperlink, which I include in here. That's 7 misconceptions of Bitcoin. Wow, James, I can't believe it. Like 2 hours and 10 minutes. This breaks my record of longest YouTube video and podcast. I hope we didn't put anyone to sleep. This is, you hear the exuberance in my voice. I've been in the community of family offices investing in wealth for a long, long time. And I am really excited about this. I wish I got into it, years before, but I can't lament. I still think it's early in. And by the way, I will remind people, you need to do your own diligence. We're recording this towards late December of 2020. Maybe you hear this in 6 months and so much has changed, or in a year or two. It's guaranteed so much will change. It's often our opinion at this specific point in time. You need to put in the time, do your research, form your thesis. You need to be careful. You need to do diligence. You need to limit your exposure. And for sure, in theory, you can lose everything. Understand that, be careful, and do your own diligence. James, if I had to give kind of the last word to you before I do a podcast close, if you wanted to do a comment, a summary, a recap in a minute or two to cover the 2+ hours that we did, I'm going to give the floor to you for a little while.
Yeah, I would think just very simply, obviously everybody needs to form their own thesis, their own opinion, do their research before they make a decision. But I kind of look at it this way. Let's just say 1% of, an institution or a family's net worth or even an individual. If you lose that 1%, it's not going to ruin your life or change your lifestyle. So if you're 99% everything else and 1% exposure to Bitcoin, Ethereum, and other cryptocurrencies and things of that nature, if that pays off, that could have an enormous change of someone's life, especially the way that Bitcoin has performed over the last 11 years. And I guess the consequence, if we have hyperinflation or something really goes wrong, of not having that 1% exposure, is the juice worth the squeeze, is what I always say. So you're taking some risk, obviously, like anything in life. Even walking across the street is a risk. But if that 1% truly pays off, it might just be an insurance that you hope never pays off and you actually hope goes to zero and everything else goes great. Or it could be that asymmetric bet of a lifetime that really changes everything, especially the longer we live and as time changes. But at the very least, even if you don't purchase or participate in any cryptos, just learning about the future of programmable money and dominant digital networks and just where everything was going is going to be of immense value, just having an underlying knowledge, because it would really be awful with central bank digital currencies if somebody could be worth billions, but they don't understand how the system works and they literally need hand-holding just to buy a loaf of bread. That sounds extreme, but it's not impossible.
Yeah, I mean, that's the example that I gave earlier. Completely true. And that was a wonderful recap. I'm going to do a little bit of a close and maybe a little different than some of the closes I've done. So don't leave us if you're listening, because I may have some interesting comments too about what's upcoming. So everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast, and I'm the founder and CEO at Family Office Association. We're a global membership organization dedicated to families of wealth and their family offices. So again, a couple of things. I'm really excited about this community. I really enjoy doing the 2+ hours today. I've been so fortunate to interview to some truly amazing guests about these subjects. And don't think that I don't look to cover the other side and that we're not diverse in terms of what we do. I mean, I've interviewed Peter Schiff, and I have a request to have him come on again, hopefully in early January. And I think Peter does some things that are great, and he's a tremendous advocate of gold. And I enjoy many of his views, but I would like to discuss with him about Bitcoin. I guess you could argue a debate. So we're looking to that. Jim Rickards is coming on 1/6, and I wouldn't say he's a Bitcoin advocate. He's a big gold guy, very thoughtful. I enjoy, certainly his books and the things that he talks about. So I do think you should listen to all sides of the argument. I think oftentimes people make sense in some of the things they say. It's just you have to weigh it against your research and diligence that you do and make a decision. So I do recommend looking at and becoming a member. Go to familyofficeassociation.com. It's very easy to see membership, whether from a corporate partner or from a family or buy-side family office or MFO. And all we're doing, from our proprietary research and thought leadership to tremendous discounts and benefits, to I'm still doing some level of very intimate private events, but full-fledged events will come back sometime in 2021. And I do lots of private digital programs, including investment dinners, virtual dinners. I got so much going on that it's an opportunity for you to engage by being a member. And I do give away a fair amount of things for free. Go to my YouTube platform. Simply, it's Family Office, where we keep a fair amount of content. My Apple and Spotify podcast, the Angelo Robles Podcast. But again, our special handholding in much of what we do, and really some tremendous opportunities, values, and benefits come from being a member. I did mention as well, there's consulting I do inside Family Office Association, mainly how to create a family office, how to be international, and how to adapt during today's times with technology to virtual family office, etc. And we'll be teaming up with James and have, launching what we're going to be doing to help families on all the issues we discussed today that I think are going to be a little hard and complex to navigate, exponentially increase your knowledge in 30 or 60 days that may take you a lot longer if you were to simply do this on your own. And is that going to be valuable to you? And that applies to many of the things I do within specifically the single family office community. So go check us out on social media. Check out familyofficeassociation.com. And my direct email is angelo@familyofficeassociation.com. Thank you all for listening to this record-breaking time-wise podcast or YouTube video if you're watching it on there. And a special thank you to the great James J.J. Sowers. Great to have you on, buddy. Look forward to the next time.